Welcome back to Switzer on Australia's business channel. PM Capital has been a smart performing fund business, but soon it will list, or one of its funds will list on the ASX. To understand why the business has drawn a lot of positive attention, we have investment analyst Uday Cheruvu. How are you, mate?
Good.
I know I stuffed it up earlier, but it happens.
That's right, Peter.
Mate, more importantly, you're here.
Yep.
And it's been an impressive story. The fund of yours that focuses on foreign stocks has done 54% since September. 54.2, I think it was.
That's right.
Don't
know the exact numbers, but yeah, around about that.
Oh, okay. So that was one of the reasons why I was interested in bringing you guys on the front. Just give us a bit of history. PM Capital.
Yeah, PM Capital. So we set up in 1998 by Paul Moore, who used to be the head of the international equities business as BT.
Yep.
He'd been there through the 80s and basically left the company to set up PM Capital. One of the reasons he set up PM Capital because he wanted to set up an organisation with culture and basically the environment to facilitate basically the investment process. The investment process is to buy a good company at a good price and to focus on that.
Okay. And so the funding in question, what is the investment style there? Don't say it's just good companies at good prices. And there must be more to it than that.
It's a little bit more to it than that. Basically, how we focus and how we look at investments is we think fundamentals such as earnings profile and earnings trajectory is what finally determines what a share price and evaluation of a company should be in the long run.
Yeah.
But in the short run, what you will see is macro events like tapering, maybe company-specific news, cause volatility in the stock price, which
an ECB decision that could either hurt or help.
Absolutely.
Trichet's decisions hurt, and Drago's helped.
Absolutely.
Yeah.
So, but in the long run, what we see is earnings, and what happens to earnings is ends up determining share price. So therefore, we take these opportunities when the markets do give these to investing stocks.
Okay. Now, as you can see, I'm here saying nice things about you, but this is the real world. After the GFC, with you guys buying foreign, there must have been some hairy moments in your life as well. Because I say, the ECB boss, Trichet, made some stupid decisions. He was raising interest rates when he should have been cutting. And then your life must have improved when Drago came along and said, well, whatever it takes.
No, absolutely. I mean, during the GFC, during 2008, 2009, it was a very hard time for us, as it was in most fund managers. But given our investment philosophy where we focus on 3 to 5 year returns, we were quite happy to sit through the volatility, and what we saw, the volatility created more opportunities for us, and that's how we got to the 54% return, is because we were able to make decisions, not thinking about what their next decision is going to be, or the next 3 to 5 year impact of that decision.
Because it is interesting that you've made some fantastic returns. Was there a certain geographical reason that got your attention in that year when you made 54%? I'm hoping you'll say Europe.
Not quite. We actually made a lot of our return from the US.
Okay.
And if you looked at the US was the epicenter of the GFC, in particular the housing and the real estate. We invested in a number of businesses, which had, for example, Howard Hughes, which is a Las Vegas developer, which is the epicenter of the housing crisis in the US, and investments like that, which people didn't really like back in 2009, 2010, 2011.
Yeah, it looks scary.
Exactly.
Yeah.
And that's where we made a lot of our money.
Okay. And so I guess what you can do, what the normal investor can't do, is you can do the research on a company in a foreign land and have confidence because you've got that expertise. That's
right. The way we have structured our team is basically on an industry segment basis across geography. For example, I look at the banks and some technology companies.
But banks all around the world?
All around the world.
Yeah.
And how that helps is I can see what's happening to banks because of increased capital levels in the US, and then how does that translate into Asia? Yeah. We've seen what happened when provision levels increased in the US. We can understand what will happen in China. That's why we're not invested in Chinese banks, but we are invested in US banks. And so it gives that across the globe look, gives us a better feel for where the anomalies are and where we can invest.
Now, my research on the analysts in America who I respect all think that US banks are going to have a good year going forward. Why is that? What's the thinking behind that?
The thinking behind that basically is two-pronged. Firstly, you've seen a lot of provision build-up during the 2008-2009.
Yeah.
So banks are over-provisioned in the US.
Yeah. So for normal people out there.
For normal people out there, sorry.
Yeah. So they've presumed that their bad debts and business going broke on them was a lot worse than
Exactly.
And because the US, and I often talk to my viewers about US economic growth. As that improves the provisioning, and therefore is good for the banks.
That's right. It improves consumer sentiment, and also there's been no loan growth for the last 3-4 years.
Good point.
And you'll see first slow amounts of loan growth, and this won't happen across the board. It will only happen to the best capitalised banks, because it's not everyone benefits at the start. It's only the guys who are in the strongest position benefit, and that's why we've invested in banks like Wells Fargo, which are the best capitalised, with the biggest market share and the highest deposit base, and which we think will have better earnings profile, that benefit more when the first recovery when the recovery kicks on.
Is there, on the same principle then, because I can remember when I took my show to Wall Street in 2010, my wife and I were walking down Park Avenue, and we saw Bank of America there, and she said, should we buy Bank of America? And I said to her, the answer probably is yes now, but for the next 6 or 7 months we could look like nincompoops. It was a great time to buy Bank of America. It was cheap as chips.
Absolutely, and that's our thinking. We know that in some time in a short run, our decisions may look weak, or people might get worried, but
courageous.
Well, but in the longer run, that's when the payoff comes through, and that's why we basically set up the LIC, which is a listed investment company, which I don't know if many of the viewers.
Let's for those people who don't understand what a LIC is, a listed investment company, explain.
Listed investment company is primarily a managed fund that's set up on the stock exchange. So most managed funds, you'd have to go through a financial advisor or apply directly to the fund manager.
You buy units.
Exactly, you buy units. Whereas in a listed investment company, you buy shares into a company that basically follows the same mandate that our Absolute Performance Fund has. So what that means is provides liquidity to investors. Where in a managed fund, you'd have to go through your financial advisor, take T+2. You directly go on the stock exchange and buy and sell it at any time. Yeah.
Of course, LICs have one downside, and you'd be aware of this, that when everyone panics, they tend to panic too much with LICs, and there's often very good value in sticking by them as long as people don't drag their money out.
Absolutely.
But that's another issue for another day. I noticed, I read with great interest that private equity companies are now starting to get back into Spain and Italy. To me, that sounds like a really good sign that things are turning, even in those basket case economies, when those vultures, those private equity guys are going in looking for value in companies.
No, I absolutely agree with you. We actually are looking at Spain also. I went to Spain 2 months ago.
Oh, you poor bloke. All for business and tax deductible reasons.
Absolutely.
Okay.
No, in terms of the opportunity set there, what we see is probably similar to what the private equity guys are seeing. Where we're coming from is try to understand whether the factors that drove the negative returns and negative impact on Spain, i.e. the economics, the debt levels, to the labour conditions, and the lack of productivity in Spain, we need to see improvements there, or some sort of a trajectory that we can say, yes, if we see A, B and C, we can have some sort of certainty that things are improving. And that's what we're basically trying to do. Private equity is looking at it similarly. We're looking at it similarly. So there's definitely opportunities there. Maybe it's too early, but it's something that we have our eye on. Okay.
The 2014 view for the Australian economy and stock market, because you go right around the world, and I've made the point a few times that if you're a very cautious investor, even buying banks today, if you get the 5% yield and it grosses up to 7%, you could probably think we get a 3% gain. That's 10%. Is that too unrealistic saying that?
Peter, to be honest, the Australian banks, we have a slightly more bearish view. We think the dividend yields are supportable. We don't think there's any near-term risk that you'll see banking system collapse. But from a global perspective, you're looking at something like a CBA, which is a very well-run bank. It's trading on 3 times book. You compare that to equivalent, again, say, let's go back to Wells Fargo, it's trading on 1.3 times book. Where would you rather be? On that relative basis, we'd probably preferably see more downside in earnings risk for Australia than relatively. From a 2014 perspective, the tapering is going to be the big event.
Yeah,
that's going to create market volatility. But we ask ourselves, is the tapering going to change the earnings profile or earnings trajectory of companies in 3 years from now?
No.
Probably not.
No.
And so that's why, in our view, is whatever tapering brings, it creates an opportunity.
Yeah, and it seems to me that when tapering starts, as John Calamnos said, that people are going to say, the Fed's doing it because the US economy is getting better,
Yep.
and we're a long way from normalcy, but
Yep.
normalcy is going to be out there, and
Yep.
that's when banks' PEs are more like 15 or 17 than what they are now.
Yeah, or 17. 17 is a big number, but yeah,
but before you crash, they often get to 17. What I'm saying, Bank of America is probably what, 12 or something like that.
It's around that.
Yeah. So, all right, great to talk to you, mate.
Great to
Thanks for joining us on the program, and good luck. When is it actually listing? The date?
The listing date is on the 12th, so the offer applications close on the 29th, but the allotments happens on the 6th and it's on the 12th.
Okay, mate. Thanks for joining us on the program.
Thank you.
All right, so that's Uday Cheruvu.
You'll get it right.
I don't know why I even tried to do that. Thanks for joining us on the program, Uday. After the break, ever wonder what it's like to own a cruise ship? Our next guest is a founder of a French-based liner, so don't go away.